So I had the most amazing time yesterday. I was on the live where I was invited to have a conversation around investment and doing business in Africa by Kingsley, the Growing Man podcast. I'm probably gonna tag him as well, so you can check out his TikTok page. And I was mind blown at the quality of the conversation, but also the amount of questions I've gotten over the past few hours. So I wanted to make a video to kind of explain investing in businesses because of what we're trying to do and what it entails. But I just wanted to give the basics of what it is because there's a lot of confusion. And I realized that there are a lot of conversations that are not being had in in our communities. So yeah, I just want to give a basic, but I'm not a financial advisor. Obviously, I'm not a financial planner. This is not financial advice. I'm just giving you knowledge. This is just for education purposes. So we're gonna talk about first impact investing, which was one of the things that I discussed. It's probably gonna be a one or two part video, but hopefully I'll be able to do it in the single video. So impact investing, I want you to think of you having some money that you want to invest. Normally you might put it in a company or a project just to make more money, but instead, you might decide to invest in a way that not only makes you money but helps you makes the world a better place. For example, and that's what we call impact investing. So you put money in a business or a project that has for a goal to do good in the world while also making a profit. So it has two purposes: positive impact. You are solving social, economic, or environmental problems, and you are making a profit. So those are like your renewable energy project, affordable housing, health, and education. Those are your impact investment. Then we had angel investing. I believe that's the next one. And let's say you're an entrepreneur, you have a great idea for a new business, but and you need money to get started. So that's where angel investors come in. It's where wealthy individuals that are known as angel investors, they provide the capital to you as an early stage startup in exchange for ownership a portion of your business, or what is known as convertible debt. Sorry. Here's how it works. They usually come in at the very beginning of a startup, and maybe the business does not even have any revenue or any significant revenue, or does not even have a product. And they know it's high risk, high reward, so they know that they might lose everything that they have, but it has a high potential for return. So they might say, "Hey, I'm gonna give you this money, and I'm gonna take 20% of your company." So they might decide to invest maybe $100,000 in exchange for 20% of your company. If your business becomes popular, it makes profit. Maybe the company is now making around a million. Then that 20% has a value of 200,000. So they've just doubled their investment. So that's angel investing. The next one is grants, which is also a popular way to fund your business. So let's say you have a business and it's solving the economical problems, social problems. So you apply for grants instead of giving away part of your business or actually taking on debt. So there are sums of money given by governments, foundations, corporations, or other form of organization to support specific project or activities, and there's no repayment um, required. However, it has to be served for that specific purpose. Otherwise, you're going to give the money back, and there is a reporting. You need to report on how you spend that money. Now, the next one is venture capital. This is now one of the most popular, especially for a form of private equity for startups, especially in the technology sector, where you raise capital, kind of like impact investing. But impact investing, remember, they were about making profit and solving socioeconomic problems or social issues. Now, with venture capital, they do the same thing. Each state it's mostly focused on making money and making a profit. So startup founder, you have an idea, kind of like in angel investors, you go to them, they give you the money. They usually want to exit your business within 5 years, so they want you to make a profit, and they want to sell the company, but they give you money in exchange for a portion of your business. You then have growth capital. Growth capital is one of my favorites, is because in growth capital you invest in businesses that have proven themselves, have established themselves, they've grown to a particular level, but they want to scale and they need access to capital. So instead of borrowing money from the bank or something of the sort, so they sell a portion of the business to scale the business. So they give, so maybe instead the company is already making maybe 2 million, 3 million. So they maybe say, okay, for a million, for maybe 500,000, we going to, you take 10%, I'm giving an example, of the business, and they take that capital to invest in the business so that it can scale. So that is what grows capital. And then another one now is private credit, because I got a few questions around private credit. So private credit is actually, let's say you don't want to take on debt from the bank and you don't want to sell a portion of your business, so you will go to the private market and borrow. There are different forms of private credit, but some of the most popular is revenue-based financing and mezzanine debt that I will explain quickly, and then we'll go to initial public offering. So I kind of touched on mezzanine debt yesterday. So it's safer for the investor. So it's kind of a mix where it's less risky, because unlike a regular loan, you do not have regular payments like where you paying the payment agreements, and repay it when you make money. And for the investor, if your business make more money, they make a lot more money than maybe with a bank loan. So it's like a combination of a loan and kind of like your own money. It's riskier than a bank loan, but safer than buying shares into your business outright. So it's that's what mezzanine debt is. Revenue based finance, I think it can be self-explanatory. It's you take on the loan and you split the revenue until you pay back the money, the principal and the interest. So whatever money you will be generating, the private credit facilitator will be also getting some of that as a form of payment in order for you to repay the loan. Then there's initial public offering, which is what most people are familiar with. When you go to your JAC to buy um, shares, that's usually a company might be looking to raise money to scale or do something. So they take a portion of it and put it in the public market and they sell it. It's not just any company. It has to be a company with a certain level of revenue already in order to be listed. But by the time you are buying shares in that stock market, a lot of the things that you're seeing, impact investing, grants, angel investing, venture cap, as growth capital, has already happened. So let's say, for example, you had angel investors that had invested in the business, and the business is going into an initial public offering. What will happen is a lot of the money that is generated through the stock market is what they're going to kind of take as what they cut. They're like, okay, I want to cash out my investment. That's what they will take. Like the growth capital investors and all those people are the ones that how they take the money out. But an initial public offering is a way now, instead of raising money through these other means, they raise money from the public. Hopefully, that answers a lot of the questions that I got. I know that this conversation is definitely going to be ongoing because I got a ton of questions, and I believe Kingsley might have gotten a ton of questions as well. So feel free if this is the first time you are getting like meeting me, so hopefully this serves you. I know this video was a long one, but yeah, do connect, do follow, do subscribe. We'll definitely look into creating this type of content a lot more. I had no idea that it was an area of interest for many.